Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Extra Space Storage Inc. Annual Report. Extra Space Storage Inc. is a leading provider of self-administered and self-managed real estate investment trusts, REITs, in the United States. The company operates 4238 self-storage stores across 43 states and Washington, D.C., offering a wide range of storage solutions to customers. The company's services include boat storage, RV storage, and business storage, catering to various needs of its customers. With approximately 2.9 million units and 326.9 million square feet of rentable space, Extra Space Storage Inc. is the largest operator of self-storage properties in the country. Its extensive network of conveniently located and secure storage units makes it a go-to choice for individuals and businesses seeking reliable storage solutions. The company's services can be summarized into three main categories: residential storage, commercial storage, and specialty storage. Residential customers can choose from various unit sizes to store their personal belongings, while business owners can opt for larger spaces to store equipment or inventory. The company also offers specialized storage options for boats and RVs, making it a one-stop shop for all storage needs. Overall, Extra Space Storage Inc.'s comprehensive range of services and extensive network make it the leading provider of self-storage solutions in the United States. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a stock's price to remain stagnant over a period of time. The stock market is inherently unpredictable, and there are numerous factors that can contribute to a company's stock price remaining unchanged for an extended period. One possible reason is a lack of significant news or events that would impact the company's performance or industry trends. This could be due to the company being in a stable phase, with no major announcements or developments that would influence investor sentiment. Another factor could be the overall market conditions. If the broader market is experiencing a downturn or stagnation, it may affect the stock price of individual companies, including Extra Space Storage Inc. Additionally, if there are no significant changes in the company's financials, such as revenue growth or earnings per share, investors may not see a compelling reason to buy or sell the stock. Furthermore, industry trends and competition can also play a role in determining a company's stock price. If the self-storage industry is experiencing a slowdown, or if Extra Space Storage Inc. is facing increased competition from other companies, it could impact the stock price. However, without access to specific data or news sources, it is difficult to pinpoint the exact reasons for the stock price remaining stagnant. In conclusion, there are various factors that can contribute to a company's stock price remaining unchanged over time. While Extra Space Storage Inc.'s stock price may not have shown significant changes in the past year, it is essential to consider multiple perspectives and data points to understand the underlying causes. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, an increase in the number of stores owned and operated, expansion of management business through third-party store management, and growth in net rentable space are significant contributors. Additionally, the company's bridge lending program generates interest and fee income, while acquisitions of new stores and leasing available self-storage units also contribute to revenue growth. Furthermore, managing unit rental rates, tenant payment of required rental payments, and adjusting rental rates through industry-leading technology systems and revenue management teams help respond to changing market conditions. The company's property rental segment has seen improvements in operating results at same-store properties, while the tenant reinsurance segment has experienced an increase in the number of stores operated. On the decline side, adverse changes in general economic conditions, competition from new and existing stores or other storage alternatives, and failure to close pending acquisitions and developments on expected terms can negatively impact revenue. Reductions in asset valuations and related impairment charges, disruptions in credit and financial markets, and changes in global financial markets, including increases in interest rates, also contribute to revenue decline. The company's tenant reinsurance expense has decreased, while general and administrative expenses have increased due to stock compensation expense. These factors highlight the importance of monitoring market conditions, managing operations effectively, and adapting to changing economic circumstances to ensure sustained revenue growth. Net income and profit margins changes. A mixed picture. The extracted summaries reveal a mixed picture of how net income and profit margins changed over the years. On one hand, net income decreased by 12.3% from 2024 to 2025, indicating a decline in overall profitability. However, this decrease was followed by an increase of 13.7% from 2024 to 2025, suggesting that the company's financial performance improved during this period. A closer look at profit margins reveals a similar trend. The self-storage operations profit margins decreased from 72.5% in 2023 to 69.9% in 2024, and further dropped to 67.6% in 2025. This decline suggests that the company's ability to maintain profitability has been impacted by various factors. The inconsistency in net income data across different pages highlights the need for a more comprehensive analysis of the company's financial performance. Despite these challenges, the summaries provide valuable insights into the changes in net income and profit margins over the years. The company is generating a significant amount of positive operating cash flow. According to the financial statements, the net cash provided by operating activities has been steadily increasing over the past 3 years, reaching $1,850,193 in 2025 and $1,887,430 in 2024. This trend indicates that the company's operations are generating sufficient cash to meet its liquidity requirements. The company's ability to generate positive operating cash flow is a crucial indicator of its financial health. It suggests that the company has a strong foundation for growth and can invest in new opportunities without relying on external financing. Furthermore, the company's expectation to fund its liquidity requirements out of its operating cash flow demonstrates its confidence in its ability to manage its finances effectively. Overall, the data presented indicates that the company is generating sufficient positive operating cash flow to support its operations and meet its financial obligations. This trend is expected to continue into 2025, providing a solid foundation for the company's future growth and success. The company's debt level and interest expenses have undergone significant changes over the past year. According to the financial reports, the total debt has increased by 6.4% from $12,600,661 in 2024 to $13,481,899 in 2025. This increase is reflected in the higher interest expense, which rose by 6.6% from $551,354 in 2024 to $587,613 in 2025. The net cash used in financing activities also saw a substantial increase from $202,290 in 2024 to -$1,036,103 in 2025. This indicates that the company has been using more funds for debt repayment and interest payments. The interest paid by the company has also increased, rising from $499,417 in 2024 to $564,665 in 2025. However, there is a discrepancy in the reported interest expense figures across different pages of the financial report. While some pages indicate an increase in interest expense, others show a decrease. Despite this inconsistency, it is clear that the company's debt level and interest expenses have changed significantly over the past year. The performance of various segments and regions within the company has been analyzed. One segment that stands out as a performer is self-storage operations. According to the extracted summaries, this segment is expected to perform well in the long term. In fact, it has already shown improvement, with net operating income increasing from $1,610,542 in 2023 to $1,977,042 in 2025. On the other hand, there are no segments or regions that have been identified as poorly performing. This suggests that the company's overall performance is strong across all areas, with self-storage operations being a notable exception and a key contributor to the company's success. Management is optimistic about the company's outlook, citing opportunities for growth through strategic management and technology systems. They aim to maximize cash flow and achieve sustainable long-term growth by pursuing revenue-generating and expense-minimizing initiatives. The company believes it is well-positioned to compete in a consolidating industry, with significant growth opportunities existing for operators with proven management systems and sufficient capital resources. To manage risks, the company will continue to use leverage in its capital structure, while prioritizing maintaining liquidity through operating expenses, debt service payments, and distributions to unit holders and stockholders. Management is also focusing on addressing underperforming locations by classifying 5 stores as held for sale. The company expects to close a $12,500 acquisition in 2026 and plans to originate $57,700 in bridge loans. Overall, management strategy focuses on sustainable growth, risk management, and strategic decision-making to drive long-term success. Acquisitions and divestitures are significant business strategies that can impact a company's growth and financial performance. In recent years, our company has been actively involved in acquiring new properties to expand its operations. We have entered into several acquisition agreements, including the purchase of 1 store on February 18, 2025, 6 stores on October 28, 2025, and 1 store on November 12, 2025. These acquisitions were made possible through the issuance of operating partnership units, OP units. Additionally, we have acquired 58 wholly owned stores in 2024 and a total of 134 new stores in 2025. Our company has also been involved in joint ventures to develop new stores and acquire existing ones. Furthermore, we have entered into a merger with Life Storage, which resulted in the expensing of customer intangibles associated with the transaction. On the other hand, our company has also engaged in divestitures, selling certain properties that were classified as held for sale. These sales resulted in estimated losses totaling $115,830. However, we have also experienced net gains from the disposition of stores during 2025, amounting to $39,520. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. On the one hand, the company has consistently paid dividends to its investors over the past 3 years, with amounts totaling $1,374,298 in 2025, $1,375,003 in 2024, and $1,046,341 in 2023. On the other hand, the company has also been actively buying back shares from the market. In fact, a significant number of shares were repurchased in 2025 alone, with a total of 1,158,244 shares being bought back by the end of December that year. This indicates that the company is committed to returning value to its shareholders through both dividend payments and share buybacks. While there are no clear indications of inventory buildup, there are some potential concerns about supply chain management and cash flow. A slight increase in accounts payable and accrued expenses on page 39 may suggest some issues with managing cash flow or supply chains. However, a significant increase in real estate assets, inventory, from Q4 2024 to Q3 2025 on page 67 could be an indication of inventory buildup. Despite these concerns, they are not explicitly stated as inventory buildup or supply chain disruption, but rather as potential issues with cash flow and management. That concludes the financial summary for Extra Space Storage Inc. Feel free to comment below, and I will be happy to answer them when possible.